I want to ask both of you gentlemen. This is what I'll posit. It's possible that Sarat, that the stimulus actually increases fiscally, and the Fed's on hold the way it is, so that even though we've had this, what is really an outlier year in terms of returns, given all the headwinds, is it more likely that we've paid it forward and had our gains, or that the additional stimulus will keep it going? Sarat, in your view?
I think, Joe, it's more likely we've paid it forward. I think this narrow leadership that we keep on seeing, especially in the big five tech, I think will have its day. And if rates do start moving up with this increased stimulus and consumers start spending money, I think you're going to see the rotation going through. It doesn't necessarily mean stocks can't go up. It's going to be the sectors where you got to look at cyclicals, financials. It might be that some of the air is going to come out of the balloon, where stocks that were trading at 25 times earnings at the beginning of this year are at 40 or 50, and we're looking at price to sales and all the stuff that we looked at before and said, hey, valuation does matter. So the market could be flat on the indexes, but you could have some sectors doing really well and stocks doing really well, and some, on the other hand, especially the momentum stocks coming down. So as an investor, be very careful. This is the time where you got to prune the portfolio and say, hey, what do I want to own going into the next 12 to 18 months? Because the consumer will come back, interest rates will move, and companies will start spending money, and it's just not going to be zero interest rates and top line growth.
You feel, Paul, closer to what Sarat is saying, or do you have more differences?
No, I think I feel a little bit closer to what Sarat's been saying. Coming into next year, as we get towards the second half of the year is where the question's going to arise. If COVID does, recede its grip on the economy, which we expect it will, and if the economy does start to recover, which we expect it will, then the question's going to be, okay, now where do rates go? And rates are at historically low levels. And, as Sarat was just saying, valuations don't seem to matter now, and that's because rates are so low. But when rates do start to rise, you're going to see more of a focus on valuations in the market, and that could be a problem as we get out further. So the one pro here is whether, for the long term, maybe not, but in the current environment, is that the Fed has basically told us that they're not going to be doing anything for some time. Mike Santoli in a prior segment was just saying this year and next, they're not going to do anything to change their course. If that's the case, that's a tailwind for stocks looking forward. What it portends, down the line years from now is another question. But in the short to intermediate term, a Fed on hold and Janet Yellen at the Treasury, that's going to be a easy monetary backdrop for the market.
So you're sitting around watching Santoli on TV. Don't you have work or things to do or clients or something?
Well, Joe, what I'm more surprised at is that a Taco Bell actually closed near where you live. I mean, that's breaking news. And whose fault is that?
I tried to organize the community. I swear I did. I'm not kidding. It's tragic. Both of you. So, Sarat, in terms of rates rising, we have had Jim Paulson. Oh, my God. 59. We have no time. Paulson says not until 3%. Jim Paulson, not until 3% do rising rates hurt the stock market. Do you think 1.5% on the 10-year would hurt? Real quick, Sarat. 5 seconds. I
think it's perception. If the rates start rising and they start getting a little bit out of control, the markets will react before they get to 3%. They will react when they move really quickly.
Shepard Smith here. Thanks for watching CNBC on YouTube.